please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Welcome back. Well, with the eventful final series of FY18 now out of the way, all eyes will be on April series and what actually the April series holds for us. Mangalam has done a detailed analysis on the same and has pointed out a lot of cues really that are stacked up for the April series, Mangalam.
Absolutely, Anisha. You know, first things first, how has April panned out in the last three series? So, the last three Aprils, April 2015 series, that one saw a cut of close to 2%. But the last two Aprils, April 16 and April 17, they've been good for our markets. We've seen gains of almost 1.5 to 2% in the last two series. But the important part, however, is that the April moves have mirrored the sort of moves that we've seen in March. So, if March ended in the red, April ended in the red as well, and this time March unfortunately did end in the red by close to 270 points. In the last two series itself, we've actually lost almost 1,000 points on the Nifty. So to that extent, the April series becomes all the more important. Why so? Because, well, the rollovers picked up over March series, so we saw 69% of positions being rolled over, and this compares to 66% that we saw in Feb, 62% that we saw in March itself, and April saw a rollover of close to 69%. So some more conviction by the shorts perhaps is the order of the day as far as April series are concerned. We're starting slightly heavier than what we did on the March series, so 1.93 crore shares is what the Nifty open interest is at the start of this series. That compares to about 2.2 crore on average, but then again higher than 1.86 crores is what we saw in the March series. The FIIs, they are net short, and how? At the start of this series, the FII long exposure is at just 18%. That plate should come up for you. This, I mean, I don't remember the last time I saw this. Yeah. I don't think anyone remembers the last time anyone saw this, because this has never happened. 18% long exposure. That keeps the road open for a lot of short covering, but this only tells you the lack of confidence that there is. This is one point I will definitely be watching out for, given sort of triggers that we have for this series. We have the e-way bill rollout that took place on April 1, RBI policy 4th, 5th of April, status quo expected, start of the fourth quarter results season, Trump trade wars, and then you have you know, all the news flow which would come by ahead of the state elections that take place starting from May itself. So we have a lot of triggers. FII long exposure at the lowest ever, 18%. That is something I'll be watching. Let's take a look at how the Asian markets are faring. Remember, we saw by and large green screen as far as the Asian markets are concerned. We're seeing early rates come by from the Shanghai index up 0.4%. Remember, the Chinese government has imposed duties on close to 128 products from the US. That list wasn't different from the list which was earlier released in Beijing, the proposed list. So that bit of no surprise is causing a bit of a relief rally. Add to that, we saw good cues come by from the Wall Street in the previous week as well. The Nikkei up 0.6%. Slight weakness in the yen. However, they're still stronger from earlier levels of close to 109 that we saw at the start of this year. The SGX Nifty indicates a red tick. However, if you compare it to the Nifty futures close on Wednesday, we're still above by close to 70 points. So that is something we'll be watching out for. But during the long weekend, our very own Nigel D'Souza traveled to GNFC City in Gujarat and caught up with the management of GNFC. Here's a slice of that conversation.
TDI prices have been stable, and they have been hovering in the range of about $4,200 to $4,500 during the last 3 months. But more importantly, the demand has been picking up. There have been more and more export inquiries with us. And very especially, a very new trend we have observed, that countries from Africa, they have been demanding more and more TDI. So we are exporting to all continents. Now, this wasn't there. From an export of 6 countries, we are now exporting to 66 countries. And from an export in terms of value about 10 and 12 crores, we hopefully are expecting to achieve almost 600 crores.
Right.
But more importantly than the price, the demand trend has been very, very positive and very significant.
What was the total debt in the books? What was the working capital, and what has it come down to?
Working capital utilization used to be over 1,700 crores, and that has come below 300 crores. So from that level of debt of almost 4,000 crores, the company is now practically debt-free.
But is there a possibility, sir, that shareholders could be expecting a bigger dividend payout? Could there be some value return to shareholders?
Well, again, we are a listed company, we're a government company, so I would not like to comment on that. But definitely, our board has full authority to consider that. And since we are doing very well, board might take a call.
You are mentioning formic acid. You know, reports suggest that maybe RCF, one of their units was not functioning. Maybe there's a possibility that they go and sell out. Will GNFC be interested in that particular unit? Is that a possibility?
Well, it is not only a possibility, we have asked them many a times.
Well, Dr. Gupta, another big area has been the NEEM project. Last year you did around 40 crores odd. What's the vision there?
This year our target had been about 40-50 crores, which we should reasonably achieve.
FY20, what kind of a number are you looking at?
This has a potential for achieving 500 crores turnover in next 3 years.
Well, Reliance Jio extends Prime membership by 1 year till March 2019 at no additional cost. Reema joins us with more details on that. Reema, good morning. Tell us, what does this mean for Reliance Jio and the whole telecom sector as a whole?
Well, it's negative news for the other telecom players because Reliance Jio has extended the benefit of Reliance, the Prime membership at no additional cost for 1 year, which means if you're already or if you were a Jio Prime member till the 31st of March, you can avail of the entire digital ecosystem of Jio, which means the money, the movies, the TV content, etc., for another year without paying that annual subscription fee. If you want to be a new user, that's from 1st of April, you have to pay an annual fee of 99 rupees for the entire year. Now, this is negative for the telecom players because it means that, you know, the existing players of Jio will continue to, you know, stay with Jio because you are getting all those free benefits without paying any additional cost. But it could also be a little negative for Reliance Jio because remember, Reliance Jio's latest subscription figures show that they have 175 million subscribers, which means if on an annual basis in FY19, Reliance Jio has garnered close to about 1,730 crore by way of revenues from this membership fee. And they've already got a bulk of the subscribers. I think the subscriber market share would be at 17–18% so far. So while they will make money on the new users, the existing bunch will not contribute incrementally to Reliance Jio's revenues. So this could hurt the revenues of Reliance Jio. Merrill Lynch says that they had expected a tariff update from Jio. So therefore, they expect Jio's June quarter gross average revenue per user to fall 5% on a quarter-on-quarter basis, though the absolute revenues will go up because of the number of subscribers. And higher monetization of Jio users is critical for long-term value. So net-net, negative for the incumbents, negative for Reliance Jio, but positive for the Jio subscribers.
All right, positive for the Jio subscribers. We'll keep an eye out on the telecom stocks. But one stock that has been in focus on the back of selling its hospitals business is Fortis. They've sold their hospitals business to Manipal Hospitals. What are the brokerages making of it? Ekta's here with more. Morning, Ekta.
Hi, Manga. Morning. Well, you know, I think a lot of the concerns with regards to Fortis already played out on the stock on Wednesday's trading session. But I think that there are these, you know, sort of concerns with regards to what the minority shareholders are feeling about the deal, which is emerging. So just to put it into perspective, I'm going to basically talk about an Edelweiss report, which has summed up the kind of concerns. So according to them, the equity valuation of the deal is around 7,100 crores, which is around 10% lower than the market cap pre the deal of Fortis, which was at around 7,800 crores. Now, they believe that the minority shareholders are not set to benefit from the current deal, and the deal is tilted in favor of TPG Manipal. There is no clarity in terms of the use of 1,700 crores of cash, which is generated by Fortis either. And ideally, according to Edelweiss, the company should be returning the cash to shareholders. Plus, the valuation of the hospital business in the merger deal, according to Edelweiss, is lower than the current market valuation at around 98 rupees per share is what the street is working with, or around 5,000 odd crores. The merger deal will eventually create a holding company for SRL, which is basically Fortis will become the holding company, which will attract a holding company discount as well. Additionally, there are reports this morning indicating that investors such as led by hedge fund Eastbridge have approached several shareholders, including the likes of Elliott, to oppose the Fortis Manipal. And additional reports indicate that Daiichi has requested SEBI to block the Fortis Manipal deal as well. So it seems that there could be more pressure on the stock today.
Okay, so more pressure expected on Fortis. That stock will clearly remain in focus, but a lot of stocks will remain in focus today on account of Nifty rejig. Nigel joins us and takes us through all the changes that are expected in the Nifty. Good morning, Nigel. Over to you.
Good morning, Anisha. Good to have you back then. Well, in terms of Nifty changes, a few stocks will be going out. Ambuja Cements, Oro Pharma, as well as Bosch, they're going to be out of the Nifty. But what's coming in? We have Bajaj Finserv that's coming in there. Grasim and Titan as well is making its entry into the Nifty. The likely weightages will be roughly around 0.8% to around 1.1%. Now, the rejig was announced somewhere in Feb 21st, 2018. And from there, some of these stocks, they've already factored in. For example, though the Nifty is down only around 2.5%, Ambuja Cements, well, it's down closer around 11% odd. And in terms of inclusions, well, Titan is in there with a gain of more than 14%, when the Nifty is down closer around 2.5%, telling you some part of this rejig has already played out, or maybe most of it as well has played out, with people going ahead and buying Titan, aligning their portfolios as well. Post this rejig, well, there are some interesting factors that play out. The NBFC space, now its weight, in fact, is going to be nearly around double digit. So that's pretty interesting. The BFSI segment on the whole, the total weightage in the Nifty will go up to around 35%. And remember, in the last 10 years, that's gone up by nearly around 3x. So keep that in mind. And finally, the healthcare space, at one point of time, it used to have even 8% in the Nifty. Well, that's come down to around 3.2%. And that's nearly a decade low, to be precise. It's a 9-year low that we're seeing in terms of healthcare stocks and their weightages that will have on the Nifty. That's post Oro Pharma's exclusion. Back to you all.
All right, Nigel, thanks a lot for that 9-year low on the healthcare index. But yesterday was Easter. Wishing all our viewers good health in life as well, irrespective of the weightage of the healthcare stocks in the index. But Manisha Gupta now joins us with all the updates from the commodities space. Manisha?
Well, thank you so much for that. It is Easter Monday and you have many of the important markets still shut, so we are looking at lesser volumes right now. Having said that, the cues from the previous week, from Sunday, etc., are pretty high to take a look at. China, of course, retaliating against U.S. products. Mostly it's meat and fruits, but it's a retaliation nonetheless, and that is what the markets are looking at. Much of the Chinese commodities have opened flat or slightly in the negative, as well as markets await for further response from U.S. on this one. In the meanwhile, you have seen the U.S. dollar quite steady. That had declined, or rather that had gained 0.5% in the previous week. But when you look at the previous quarter, the U.S. dollar index is down by nearly 2%. So this quarter, while we have started on a positive note, there's plenty happening in sense of, global trade wars, and that is where the cues would come in from. Another space which has started positive really is the crude oil prices. We are still holding around those higher highs that we saw in the previous week. The U.S. rig count has declined. The Saudi Arabia and Iran tensions are still on the higher side, and the OPEC compliance also quite on the higher side are all the factors that have been supportive. Not such a good news for the Indian markets, because we have seen the petrol prices hit record highs yesterday in many of the Indian cities. So that is something that you would have to keep an eye on. Also, when you look at the import bill, that is expected at $88 billion versus $70 billion in the previous year. So the numbers do not look good, especially when it comes to freight, inflation outlook, economy, etc. So crude oil clearly a dampener when it comes to the economy overall.
Okay, Manisha, thank you so much for that. But with that, it is curtains down on Power Breakfast. We leave you with the picks of our bullseye contestants for the first day of this financial year. Bazaar Morning Call comes up next. Stay tuned for that.
My first pick is Berger Paints. I buy it with a day target of 280 and a stop loss of 245. Second, NBCC. I buy it with a day target of 200 and a stop loss of 185. Third, Motherson Sumi. I buy it with a day target of 325 and a stop loss of 290. Fourth, Jet Airways. I sell it with a day target of 570 and a stop loss of 630.
The first buy recommendation is on Apollo Tyres. One can buy Apollo Tyres for a target of 288 with a stop loss of 271. The second buy recommendation is on Bajaj Finance. One can buy Bajaj Finance for a target of 1815 with a stop loss of 1719. The third buy recommendation is on Capital First. One can buy Capital First for a target of 653 with a stop loss of 607. And the final buy recommendation is on Colgate. One can buy Colgate for a target of 1084 with a stop loss of 1039.
My first call is a buy call on Shiva Cement. Buy Shiva Cement. Stop loss 24.25, target 29. My second call is a buy call on Thomas Cook. Buy Thomas Cook. Stop loss 259.80, target 315. My third call is a buy call on 8K Miles Software Services. Buy 8K Miles Software Services. Stop loss 659, target 734. My last call is a buy call on Godrej Industries. Buy Godrej Industries. Stop loss 537.80, target 567.